Good morning and happy Tuesday, everybody. This is the Rick Helps Real Estate Show where we look at numbers. It's starting to change now, so we need to pay attention and see if we have a trend or not. But good news today, it's only going to be 116, not 119. You'll really feel that 3-degree difference, won't you? I think the reason that they pulled the temps down is we've got a huge fire out east of us. It's brutal. So we've got the smoke just hovering over the valley. The moon last night was like bright orange. So pretty rough out there. It's a big fire. Big fire. It's a problem. Um, got a couple questions of the day this morning that I want to get to. But let me start with the numbers here first. Our listings for today are 5,329. That's above. We've been averaging about 48 to 4,900 on a Tuesday, so this is encouraging. 7-day moving average, 4,013 homes came on the market. 3,788 went under contract. That's a difference of 225. That kind of got cut in half on the 7-day moving average for just a second. And so you can see here on the chart that the blue wave is still above the, these are listings that are coming on. These are homes that are going under contract. So as long as that blue line starts climbing up, I'm encouraged. And so, but we're going to talk about all the crash talk. And I don't like to make long-term predictions, but I think if somebody tells me that something's going to happen, I'd like to see a little more details. And I really agree with Michael Zuber at One Rental at a Time. He gave 10 reasons why people are saying the market's going to crash and why he thinks that's wrong. And I put the link down below. So take a look at it. It's interesting. I'm not arguing with anybody, but I think one of the main points that Michael said is if you say there's going to be a crash, then what are you saying? We're going to be down 5%, 10, 20, or are we just going to be flat? In other words, we're growing at almost 30% right now, and if we're only growing by 2, is that a crash? So be specific with your numbers, I think is what he's telling us. Let me jump to these questions here first real quick. Esther and Jimmy, question of the day. Now you say question of the day, but you have 2 of them up there. Would you spend the money professionally landscaping your front and backyard prior to selling your home in this market? Yes, but depending on your budget, the front yard is remember, that's like your profile pictures in the listings. So if your front yard looks awful, that kind of pulls back the desire a little bit. How much money would I spend? I really don't know. I think so. Let's just talk the front yard first. You just get a landscaper to come in to just trim it and make it look nice and make sure your edges are trimmed and your lawn looks good. That's not going to cost you a lot of money. If your backyard really doesn't have a lot of landscaping in it, but it's still clean, and people come in and go, oh, that's a blank slate, I can do anything I want with it, that can be appealing. If they look back there and it just looks like nobody's touched it in 10 years, that's a major turnoff, and that's a problem. So if you're trying to get the top of the market, the front and the backyard really has to glisten. But I wouldn't spend a lot of money in the backyard because you're going to be putting in smaller plants that really aren't going to look good for maybe a few years. If you're putting in hedges now, they're only going to be this tall. So I wouldn't spend a lot of money on that. And plus, if you're landscaping the backyard and you're going to put it in according to what you think you like and the landscaper likes, the buyer is going to come in and go, I wish they hadn't have done that because I would have done it differently. And they only think that way because the plants aren't mature yet. Now, if you get into a backyard where the tree is good, where it's providing shade, you have an outdoor kitchen outside, the hedges are all grown up, then people aren't going to say, oh, gee, I want to change that. They're going to say, I love this. But when everything's new and fresh and tiny, up here they go, I wouldn't have done that way. So short answer is, yes, I would definitely spruce up the front yard, and then I would make the backyard clean, but I wouldn't spend a lot of professional money having it landscaped. Second question I like. How hard is it for a seller's agent to justify the price of a home to a buyer's agent if seller's agent feels the home is dramatically overpriced? Well, first of all, if the seller's agent feels the home is dramatically priced, then the seller and the agent didn't really have a very good conversation up front. That just means the seller gave up and says, fine, I'll just market whatever you want. If you want 900,000 for it, that's what we'll do. Remember, we have a fiduciary duty with our clients, whether on the buy side or the sell side. So if the seller really wants to overprice it, then that ends up being a real conversation. We don't just slide in and think in the back of our mind, overpriced, because we're going to sit down and we're going to look at the price range together. Your home comps between 500 and 560 right now. Where would you like to price it? Here's my opinion on how I think we're going to get the most eyeballs on the home if we price it right here. So if it's overpriced and the agent feels it's overpriced, then both of you have failed in that initial conversation. Now, to answer your question, if I think it's overpriced, how do I have that conversation with the buyer's agent? Those conversations do happen, but they're usually kind of short. The buyer's agent will call and go, "What the hell were you thinking pricing that home that way?" And all I can say is, well, look, send me an offer. I'm not going to say, well, she overpriced it or he overpriced it. That's violating my fiduciary duty. What I can say is, well, we looked at the comps. This is the price that we came up with. And so now that buyer's agent has to decide whether they're really serious about looking at their house or are they just making it a hobby, calling other agents and telling them they're idiots. So I do get those phone calls sometimes and say, that seems really high. And I think more of those phone calls are probably happening now. But when you tell an agent, well, if you feel it's high, go ahead and pencil me an offer and let me present it. And then they can give me the number that they're happy with, and maybe you'll end up being happy with it as well. So again, I think the initial problem is if the seller's agent thinks that the listing is priced too high, that was a failed conversation at the beginning. Silver Rose Gaming, Rick, do you think it's better to buy down my points on an FHA loan when I can refi into a conventional in 2 years? I ask because I'm assuming rates may be higher. I think everybody's assuming rates are going to be higher, but nobody really knows how much. We're looking at the inflation numbers right now, and people are thinking that it's going to stick and it's going to stay, and therefore rates are going to go up. We're probably going to know more by tomorrow night, Thursday morning, what the central bank thinks and how the market reacts. I don't expect any kind of big spike either way in that. Spend the money to buy down your points when you can refi into, that really depends on what you're thinking on your budget. I mean, if you spend money to, permanently lower your interest rate and you're comfortable with that payment, then yeah, I'd do it. Can you refi in a couple years on a conventional loan? Just going to have to wait and see. I'm assuming you just want to get rid of your PMI. So that's a wait and see conversation. I don't know. I can't honestly go out that far. So let's take a look at what's going on here. We talked a little bit yesterday about how things may be marching towards normal. And if we look at the Crawford Market Index, you remember this is a mathematical calculation that they do, Michael Orr does, that tells you the strength of the market. So, if it's anything above 100, and see, you don't even see the number 100 here. The bottom is 350. Anything above 100 means it's beneficial for sellers and not for buyers. And we hit a peak in March of 514. But see how it's steadily coming down? This is still on fire. 400, 430, that's still an aggressive market. But what they're saying here is it has taken 95 days to fall from the peak of 515 to 436. It took only 67 days to rise by that same amount. In other words, we went up far faster here, from here to here, and we're coming down slowly. In 2005, the CMI, that's the Crawford Market Index, lost 23.6% of its value during the first 95 days following the peak in April of that year. In 2021, we've seen the fall of only 15.3%, significantly slower cool down. So the point is, what he's saying is, we are coming down, but we're coming down at a much slower pace than we did in 2005. Now, 2005 was when people were really starting to get really speculative, and we were overbuilding like crazy. And so the index started coming down because supply was growing so much. We're not seeing the supply doing that right now. And then this chart here shows you accepted contracts weekly. So up, down, up, down, up, down. Christmas. And so our accepted contracts, you can see, have dwindled a little bit here. And then this is Memorial Day. So it's a holiday. So we get a dip there and then it comes back up to 2243. So it's slightly going down, kind of like that movie Princess Bride, mostly dead, not completely dead. Median agent days on market at contract 6. So they're basically saying a home is only on the market before a contract on 6 days. And then here's the average list price per square foot at contract acceptance. So that's nothing's really dramatically changed. What I like to look at is I remember Robert Shiller prior to the debacle in 2008. I followed him and looked at his numbers closely. And Robert would give you an actual percentage of where he thought the market was going to go. And at one time, he came out and said, it's mathematically possible that our market could die 43%. So, wow, that's incredible. And you know what? He was right, but he was laying out the case. He's an economist, but he also focuses on sentiment, consumer sentiment. So he made comments again that I think some people kind of took a little out of his scope. So this is him here, and he has what he calls his new behavioral economics focused novel, Narrative Economy. The bubble in housing prices witnessed leading to the Great Recession would rather be a rather large one to match. So he's talking about there is a price correction coming, but we're just not going to see it at the scale that we saw in 2008. And here's what he says here, and this is what, I remind people, I'm 66 years old. I've only seen one crash. He says you have to remember that the drop in home prices in the financial crisis was the most severe drop in the U.S. market since my data began in 1890. Shiller said at the time, I wouldn't expect anything as severe as the great financial crisis coming on right now. And he stuck to his wait and see attitude. Will housing market crash? This is some of the stuff that we're seeing now that I'm reading that I just wish they'd give me a little more meat. So, they're giving a few reasons here. It's called the real estate agent. I don't know who they are. Home buyers are losing interest in buying properties. Okay. Well, that happens a lot. Home prices go up, they go down. There's a lot of people writing contracts. They back off for all kinds of reasons, either because they're unemployed or they just can't get the loan or they think that things are just going to turn. You just never know. But that doesn't mean there's going to be a crash. And he says another sign might point towards a housing market collapse in 2020 is the recent stock market crash of 2020. Well, we seem to survive that, so I don't see that's a problem. Increasing supply in the form of foreclosed homes. We've gone over those numbers dramatically here, talking about the forbearance. There are no foreclosed homes out there. For 2021, one of the significant effects of the year 2020 on the housing market will be foreclosures of today. I don't see any foreclosures. I don't even see any pre-foreclosures. And in fact, we are down to less than 4% of homes being in forbearance. And it went down at a record level again last week. A shift in the rental market, those numbers don't equate for me. Accelerated growth in home prices and then plateau. Okay, so you're saying because home prices go up really fast and then they plateau, that's a sign of a crash? Explain it to me. Tell me. An increase in risky mortgages. Yes, I agree. If we have an increase in risky mortgages, then that can cause problems. But we don't have an increase in risky mortgages. In fact, there's talk now that there's a little more tightening going on. So there isn't an increase. And asset bubble burst. With the real estate market trends experienced so far in 2020, it's easy to see why demand for homes is increasing. Rapidly rising home prices point out potential asset bubble, as many see it as an opportunity to invest in that asset. But what happens if the dramatic rise is just temporary and the market does not support it? Again, tell me what you're talking about. You're just saying because the prices have gone up and gone up fast, that it must collapse. And to echo what Michael was saying yesterday, people don't buy the price, they're buying the payment. If you look at 2006, when people are out there really buying, they were buying the payment with really bad loans. So a lot of people had loans out there where their interest rate was adjustable and they're only at 1%. Today, you can get that same payment, even though the price is higher, at that 1%, because we're sitting at about 3% mortgage right now. So your payments may be slightly higher than that, but the real interest rate that people were getting in 2006 was 7% to 7.5. Now, what people are getting now is a 3% interest rate fixed. They don't have to worry about a reset. And banks aren't packaging those types of loans that they did in 2006. So if you're going to say there's going to be a crash, then there has to be a catalyst. And the catalyst can be a banking crisis that you and I haven't heard of. And so maybe that'll happen. I don't know. But I think I'm seeing way too much talk that says, well, prices are going up way too fast, so therefore it has to crash. Well, what we're seeing right now is, yes, prices have gone up way too fast. And guess what's happening? Market forces are pulling us back and slowing things down. Buyers are saying, it's too high. So they are pulling back. And it's not, I remember when the crash was first starting to happen, and I had a realtor tell me, she goes, this is just a temporary pullback. And I remember telling my wife, I go, I don't think so. From what I'm reading, this looks bigger than this. This looks like this is going to get really ugly. There isn't such a thing as a temporary pullback where people are reloading their guns and getting back out there. But there is such a thing as whether or not it's airline tickets. If airline tickets get up and they're going too high, people stop flying. Real estate can do the same thing. So can auto sales. If automobiles get way too expensive, people are just going to repair their current car versus getting a new one. We have a super chat here. Let's see what this is. How is the market and timing for multifamily homes and properties? You know, I would ask you to go take a look at One Rental at a Time again. Michael Zuber, he really dives into that. Multifamily right now is parts of it are in trouble in the country because people have leverage too high, and you know that could be a problem. There are parts of the valley here where I think multifamily will still be a decent option, especially in Central Phoenix, where there's a severe shortage of places to build. So, you know, they stopped making dirt a long time ago. So I think multifamily that you could pick up in Central Phoenix area will still be good. I think Tempe, I think, is overbuilding. I was having a conversation with a gentleman the other night, and I said, you see all those luxury apartments in Tempe? I go, when did luxury living and college student end up in the same sentence? And he goes, well, student loans and parents. I said, I think that's going to end. So I think multifamily in the area around ASU here, I don't think it'd be a good investment. I think if you concentrate on Central Phoenix, Chandler Gilbert looks like they're just putting up a ton of apartments. But, you know, existing multifamily that's out here, I think if you concentrate on Scottsdale and Phoenix, then I don't think you're going to have any problem renting it. So again, thanks for the super chat. I hope that answers your question. One of the things that we look at in the market, I was getting back to payments, is that, you know, we're sitting at a 3% fixed rate right now. And in 2006, I saw people buying homes with these loans. I remember there was a guy that worked for me, and he handed me his contract on this new build he was doing. And he says, what do you think? And I said, you want my honest opinion? He goes, yeah. And I said, I wouldn't touch this with a 10-foot pole. I go, you're walking in with a $1,600 payment for this house. And I think it was a townhome. And I knew how much he made because he worked for me. And I said, you're going in with a $1,600. Can you afford that? And he goes, yes. And I said, yeah, but it's going to reset. In 3 years, this payment's going to go to $2,800. Do you see that right here? And he goes, yeah, but that's okay because I'll be able to sell it for more then. And that's what everybody was thinking in 2006 and 2007. Oh, I don't care how it's going to reset. Because if it resets, I'm going to sell it. I'm going to sell it for more. I heard real estate agents tell people, you've already got $40,000 in equity. And 2 years from now, you'll have $80,000 in equity. No, how does she know that? So that was the dangers, and that was the things that we were seeing back then. People liked the payment, but the payment was not real. So that was a crash coming. And that's what Robert Shiller was talking about a lot. He was really talking about these loans and saying, This is a problem. There is so much inventory out there and so little buying traffic right now that this could get ugly quick. And the other problem was they were bundling all the mortgages together and then selling them as a package. So the industry was saying, oh, well, there's less risk now because the risk has been spread. Well, Lehman Brothers started buying all these mortgage-backed securities, and then they found out that they really weren't worth that much, and Lehman Brothers collapsed. Well, you know who's buying the mortgage-backed securities now? The central bank. They're buying $40 billion a month of mortgage-backed securities. Now, back then, if you couldn't afford your payment, the bank said, don't even talk to us for 90 days. Because, 90 days is when they start the foreclosure process. Don't even talk to us for 90 days. Now, what they're saying is, call us if you think you have a problem. So you can call your bank and say, hey, I'm kind of having a problem. And they want to work things out with you. That's dramatically different than back then. Back then, they said, I don't even want to talk to you for 3 months. So we got another question here. I'm a first-time home buyer and considering a duplex right now, renovate and rent. Is the market too high, being that it'll need renovations? There is, I think, headed into that, I think, because a lot of people have that same idea. I'm going to get a duplex. I'm going to live in this one. I'm going to rent that one. I'm going to renovate them. They're hard to find. They're really hard to find. And when you do find them, they are selling at a premium because people want, you want a place to live and you want a rental and you want that cash flow. And there's a lot of that going on. So I think there is a bit of premium built into some of the duplexes. And some of the duplexes that I've seen that have good prices, I just wouldn't want to live there. So it's a great strategy if you can do it. And if you're good at remodeling, I think it'll pan out for you. But you're just going to have to really do your due diligence to find the right neighborhood and get lucky and get the right price. I think as a group, there is a bit of a premium there. So I know my wonderful ex-wife, and I mean that sincerely. She's a lovely lady. She wants me to keep my eyes peeled for one where she lives, because she would like to do that. So anyway, I hope that answers your question. Thanks for the question. So anyway, if I just touch just briefly on 2006 versus 2021, all the banks are willing to work with us. If we're a little bit behind on our payments, they want you to call them right away. They do not want to foreclose on you. In fact, the CFPB told the banks, I want you to ramp up your staff. We want you to get prepared with your systems. So as people exit forbearance, you don't even come close to foreclosing on these properties, because we want you to be prepared to process these loans, rewrite them, make them a 40-year loan if you have to. They're telling the banks, do everything you can to help these distressed buyers, versus 2006 where they told you to pound sand. So it's a big difference. So I hope you gleaned a little info from this. I will not be on tomorrow morning. I'm helping a friend get a ride someplace at 7 o'clock in the morning, and I'm going to be out in Sun City for most of the morning. So I will catch you, I believe, on Thursday morning. So I'll hold that and see what's going on. So everybody have a great week, and be sure and cheer that it's not going to be 119, but 116 still dangerous. Drink lots of water. Have a great day.